Let's get in a view on the macros of the economy. We've got Kilol Pandya, head of fixed income at Daiwa Mutual Fund, who now joins in on the show. Kilol, thanks very much for being with us. How would you first react to those weak advanced GDP numbers that were declared yesterday at 5%?
Slightly surprising, but only slightly, because everybody was expecting growth to slow down. But not by this much. It is heartening that today we are already seeing clarifications come in regarding some statistical element to it, which gives hope that at the end of, as we end the fiscal year, the number will not be as bad as what is being projected right now. More or less, even if it is in line with what has been the numbers which we have been talking about, anywhere in the range of 5.5 to 5.6, it will be in line with what the market is already anticipating. So it was a surprise, but only a bit. In all, it was the bond markets read it positively. Because it raised hopes regarding a rate cut in the upcoming policy. So we saw some positive moves which have only abated slightly. So weak growth outlook has turned out slightly positive for the bond markets.
Yeah, which was going to be my next question, Kilol, because the yields definitely came off a little bit as soon as those numbers came out. But so how do you expect the yields to behave over the course of the next few days? I mean, there are no major RBI announcements. The budget could well bring out some positives or negatives with regards to the overall fisc and therefore maybe impact these two.
The next data number which we are looking to see is the inflation number, which will come out soon, and then of course, as you mentioned, the budget. Both of these will have bearings on how RBI takes the monetary policy forward. Indeed, RBI has mentioned that it will be taking into account the GDP growth numbers as well as inflation numbers. So it's pretty much a given that both these numbers, that is the inflation numbers and the fiscal deficit number, which will be printed in the budget, will be watched very closely by the bond market participants. And as you correctly mentioned, not too many drivers incrementally, because the big event was the policy that has already passed. So as of now, I pretty much expect the bond markets to remain range bound on their own steam. They will probably end up reacting to data numbers only, like they reacted to the CSO number yesterday, or they will react to the inflation number going ahead. As of now, the market expects the inflation number to be not so earth-shaking, as it were, in the sense we are expecting it to be in the range of 7.15 to 7.25. So largely flattish, given the fact that the last number was which was printed was 7.18. So not too much, not too many expectations built around the inflation number. Of course, if there is a pleasant surprise and the inflation number has actually come off from where the market expects to be, then it will add to the positivity in the bond markets.
Do you think, Kilol, that a weak GDP print is going to build up hopes of a rate cut in March by the Reserve Bank?
Yes, I mean, as bond markets 101 will tell us that as we see the growth weakening, the inference is that a softer interest rate regime should be in place. The moot, the whole point has become moot because of the comments which were made by the governor and other voices in RBI immediately after the policy. The policy itself, in its tenor and stance, was not dovish. Whereas we saw a twin rate cut in CRR and repo, RBI was quick to re-emphasize and reiterate its concerns, which are broadly linked to inflation and the twin deficits. The only or one of the major areas where we can see a succor being brought about in the debt markets is a sudden swing in the growth numbers, by which I mean if the growth is seen to be slowing unexpectedly, then it makes the case that much stronger for RBI to prepone its cuts rather than postpone them.